Good evening, good afternoon, good day, everyone, and welcome to this evening's events. I'd like to thank you all for being here. And I'd also like to thank our media sponsors, the FinTech Times, FinTech Finance, and FinTechna. And of course, I would also like to thank our fellow panel members for working with us to shape this event. And you're going to hear more from them on the panel, but you're also going to hear from them on individual speeches as well. So before we get into the webinar, there's a little bit of housekeeping. As I said, there are going to be presentations. I'm going to kick off with an introduction, and there'll be a few presentations afterwards from Neil Harris, Joe Levesque, Nigel Syret, and then we're going to move on to the panel as well. Thank you very much in the chat for everyone chiming in. It's wonderful, and it's a great reminder for me to tell you that you can ask your questions in the chat, and I'm going to keep my eyes on them. If they're coming through while everyone is presenting and there's some things that seem to be burning issues, I will go to the chat. Otherwise, we'll have questions at the end of each session as well. So I said a panel will follow, to be or not to be a bank, the reality of designing and building profitable banking services. And then after that, you'll be able to join different roundtables in different rooms, and you all have received links and passwords to join one of the 4 rooms, and we'll all go off into them as well. So that's the housekeeping, and I can see that we have people from everywhere around the world today. So before we get stuck in, I imagine that you're here this evening because in somewhere in your life, your working life, someone has either tasked you or is going to task you with creating a digital bank or a digital banking proposition. Now, for some of you, you'll have a great idea of what to do and where to start. For others, it might be something that's still a little bit of a mystery. And for those of you who are not in financial services, this may even be more difficult. But you know, as we all know, in financial services and fintech now, that this needs to be a customer-led proposition, very profitably customer-led proposition. But on the other side, you have pressure from board members and shareholders to make sure that there's an impact on the bottom line. This is a dilemma, economic profitability, but also, answering all the masters involved in the organization is not easy. So tonight we're going to take a look at how you can go from inception to implementation and to scale. We'd be remiss if we didn't talk about the fact that digital banking processes, digital banks, digital acceleration has been really sped up from COVID and the pandemic. Of course, we're not living in a bubble, are we? Right? So if you didn't have it on the agenda, it's definitely coming onto the agenda, and it's not going anywhere fast. So we're going to help with some of the fundamentals and the foundations tonight. If you add to this that from a technological perspective, it's never been easier and probably less expensive to create a digital banking proposition or digital banking products and services, we do have to ask ourselves, then why is it that so many people are still losing money or doing this unprofitably? So to help us answer these questions, I am obviously not alone. I'm joined by an illustrious panel who are experiencing this at the coalface, working with some of the most well-known global household names in the space. First up from this group is Neil Harris. Neil, I can see that you're with us on the tiles. Let's see if we can turn you on. The group CCO from GPS.
I am indeed.
To call him the Bard of Banking. And you're going to talk to us about to be or not to be a bank. So I'm going to hand over the floor to you.
Thank you so much, Helen. Just sharing my screen right now. So to be or not to be a bank. Good morning, good afternoon, everybody. My name is Neil Harris, and as Helen said, I'm the Group Chief Commercial Officer at GPS. We're an issuer processor who empowers and enables many of today's fintechs and digital banks globally, including no less than 11 unicorns and counting. So to be or not to be a bank, imagine today that we're creating a bank. But before we do, we need to check out our competition. So warning, Will Shakespeare, 3 organizations that I'm going to focus on my company knows very, very well, having powered all 3 from inception to launch to the millions of users that they've attracted. So before I go on, for the purposes of client confidentiality, it's important to highlight that we take confidentiality really seriously. So all of the stats and information I'm about to share are all in the public domain. So sorry, no trade secrets here, but certainly a lot of insights. So today, GPS have powered no less than 11 unicorns and counting. We process for Starling Bank, Revolut globally, as well as processing for Monzo until April 2019, after which Monzo delivered on their commitment to their investors to insource many aspects of running the bank. So let's see how they and the two other clients, GPS, are getting on. So from a key stats perspective, firstly, looking at Monzo, they were founded in Feb 2015. They've got about 1,400 employees. Retail customers, 4.5 million. Business customers, 36,000. And total funding to date, $497 million. Starling Bank, founded in June 2014, with 958 employees, serving 1.3 million retail customers and 200,000 business customers. And total funding to date, $470 million. And last but by no means least, Revolut, founded in December 2013. Employees are 2,261, 13 million retail customers, 500,000 business customers, and total funding to date, $918 million. We're going to come back to funding a little later on. So each of these new institutions have clear focus on their strategy and proposition, although there are absolutely some lessons learned in here. So let's take a look. Monzo has a subscription strategy focused on monetization. So in April 2019, they launched 3 bundles and a subscription model. In September of 2019, they scrapped it following negative responses from their user base. And so in 2020, in September, they relaunched an enhanced offering using the user feedback. So 3% was added to cash withdrawals over £250, and £5 was incurred for any card replacement fees. It's not cheap running a bank, and they need to get their money somewhere, remember. As well as consumer, Starling has a real focus on SME for their strategy of monetization and sustainability. So in March 2018, they introduced business banking within a year of their launch. They launched a business marketplace and business loans. In April 2020, they pivoted in a COVID environment with the launch of the connected card for users in vulnerable situations. And in July 2020, they launched the paid business products, so Euro and US dollar accounts, plus a business toolkit. And Revolut focuses majorly on accessibility and UX with their super app. So they launched in 2017 their business and crypto business accounts and their cryptocurrency purchasing. Between 2018 and 2019, they launched their travel insurance and stock trading, donations and rewards. And between 20 and 21, they launched commodities trading, saving vaults, and just recently in 2021, they've launched a request to pay service. So children wish fathers looked, but with their eyes. So it's another pertinent quote from Shakespeare. That dude really had great foresight. So to put it in a different way, fintechs exist because the incumbents have not evolved and haven't responded to the needs of their users. To that degree, it could be said that the traditional banks are the fathers of fintech. So let's see how our 3 superhero fintechs are doing from a user and financial perspective. This is where it gets really interesting. So Revolut leads in achieving the fastest customer milestones, enjoying exponential customer growth aided by rapid global expansion. Starling Bank, with steady and consistent growth since launch, is the second fastest to acquire 1 million users. And after a steady but slower start, Monzo have now 4.5 million users. However, it is a fair statement to say that both Monzo and Revolut have struggled to convince users to use them as their primary banking account. Instead, they're largely leveraged and used as a second account for overseas travel and the advantageous FX rates that they offer. So to insource or outsource, that is the question, Obi-Wan. Let's take a look at funding and valuation. So as a part of this, we're going to take a look at costs and valuation. You know, launching a world-class service is not cheap. So let's look at the jurisdictions where a dedicated banking license is not required, such as the UK and Europe, where we have the e-money institution construct. India and Australia and Japan have the highest minimum capital requirements, ranging from $70 million to $15 million. Comparatively, the UK, Europe and the US are light in terms of the capital requirements for launch. But that's under a non-banking license. What about full digital banking licenses? How do they compare to the capital requirements to traditional banks? So thanks to a piece of work by McKinsey, we focused on APAC for these, as there are some really interesting differences. So on the slide here, you can see 3 bars. The dark blue bar represents the minimum cap requirements for a digital bank pre and during launch phase. The green bar shows the minimum cap requirements after launch, and the light blue bar shows the minimum cap requirements of a traditional bank. So in Hong Kong and Singapore, whether you're a traditional bank or not, the cap requirements are the same for digital and traditional banks. Whereas in Malaysia and the Philippines, there's a huge difference. And this is why we're seeing a push in these countries towards digital banking. Not only is there a need to renew technology stacks and propositions to provide a digitally and financially inclusive solution, there are also huge gains for new players, and the traditional banks are creating digital arms. So operational cost and valuation. So Monzo had a total funding, as we've already discussed, of 497 million and a valuation of 1.6 billion. And it's been reported this week that Starling has had a total funding of 474 million and an undeclared valuation
Neil,
of
just me, but I'm losing a little bit of that. So you might want to just go over that again.
Thank you, Helen. So Starling had a total funding of 474 million. They have an undeclared valuation, although Business Insider reported an expected valuation of 1.5 billion pounds on the 2nd of February 2021. And Revolut has had a total funding of $918 million and a valuation of 5.5 billion. So looking at the graph, both Revolut and Monzo became unicorns in 2018 with respective valuations of 1.7 billion and 1.4 billion US dollar. So Revolut is the most funded and most valued neobank of the lot. It witnessed a 3x jump in valuation to 5.5 billion in its most recent phase, whilst Monzo with a 40% drawdown to 1.6 billion. So how does that compare in terms of how employees and users? So Revolut number of users per employee with 4,520 users per employee. Starling has 4 times less than that number at 1,100 users per employee. And from an cost perspective, and with those operational costs in mind, consider that Monzo's operational costs are 373% greater than Revolut's by the number of users. So as you can see, with the valuation decrease in 2019, the question that we're asking ourselves is, has Monzo gone from being the fintech poster boy to a problem child? So to summarize and lessons learned, some important learnings from these 3 case studies and their journeys that we can take to the bank that we're creating together today. And I call this the 3 Ps to success. So first of all, proposition, be authentic, define your proposition. Don't just be another, we want to be another Revolut. We must hear that at least 3 times a week at GPS. End users, know your end users and what they want and what problem your proposition actually solves for them. Involve your users in the MVP and the proof of concept before launching new initiatives and services, especially if it involves new financial models for them to pay. And define where you want to be. Is your prop domestic, international, or global? If you start off with a domestic solution and proposition, it's really hard to pivot that to become a global player. Second P is partnerships. My advice is to choose your partners wisely. Demand reference points, specific to your proposition. Outsource. As an outsource provider, you know, I'm declaring an interest at this point, but I think we'll agree that given Monzo's choice to insource and the challenges faced since doing so in terms of cost and service, you know, which had a direct effect on their valuation, outsourcing has significant advantages. So you're not just buying the service, you're buying the people and the expertise that can help accelerate your business growth, so you have less distractions and keep on track with your focus. Because you're kept in current with the changing regulatory landscape, you can remain nimble whilst you focus on your proposition and delivering value to your customers. And finally, by outsourcing to a global organization, such as GPS, you have the highest bar of regulatory compliance with oversight from multiple regulators, whether that be the FCA, EBA, APRA, MAS, the Hong Kong Monetary Authority, to name a few. And the final P is profitability. Learn from Anne Bowden and think sustainability from day one. What is your road to profitability? Of our 3 examples, Starling Bank is the only profitable organisation following a profit declared in 2020 of £800,000. So now there's no turning back. And with that, I'll leave you with a quote from Nick at Revolut from the 25th of Feb 2020, who said that their focus was to increase the number of people who use Revolut as their daily account and striving towards profitability. Thank you. Thanks for listening. If you want to get in contact with me, you can connect via LinkedIn or use the details that you see here on screen. So thanks for listening again, and let's go and build that bank.
Thank you very much, Neil. And actually, Neil, there was a question in, let me just turn myself on there. There was a question in the chat asking whether or not the slides would be available afterwards. So I know you've offered up your contact details, but let me just do that little bit of housekeeping, okay? Wow, we've all struggled with our tech over this last year, so thanks very much. We were a little bit of in and out and tinny there, but you got the gist of what Neil was saying for sure, and you obviously have had the experience of 3 very different outcomes in their own ways, and we've all watched this journey with fascination. People are expressing their thanks and their insights as well. Has anyone got any questions for Neil before we move on to Joanna? Okay. No, is that okay? Just make sure that I'm checking. Okay. So we now heard about some of the information about the customer numbers and how they grew, obviously alongside the amount of investment that went into that. And then we looked at the profitability because of course we're speaking about building profitable propositions. Joanna Levesque, who's a partner for financial services at Manifesto Growth Architects, is coming up next to speak to us about the new economics of banking and building profitable customer relationships. Neil, you touched on the subscription side and the freemium and how things had to be withdrawn. So Jo, let's talk about how you get to these profitable, economically profitable customer relationships.
Thanks, Helen. I hope you can hear me okay, and thanks, Neil, for your insights to kick us off. I'm just going to share my screen. Well, hello, everybody. It's great to be speaking with you today. I wanted to spend the next few minutes just digging a little bit more into the science and some practical advice around building profitable customer relationships. And to do that, I wanted to lean a little bit on some of the research that we conducted in the spring and summer of 2020, when we talked to over 50 influencers and leaders within the banking world, a variety of leaders at incumbents, leaders at digital challengers, tech platforms, VC houses, and other influencers, to really sort of distill what the best learnings are around and what the best practice is around how you can sustainably build customer relationships. First off, let's take a little bit of a look at what the burning platform is and where the world of banking is moving to. Of course, most FS businesses are still very much focused around the traditional ways in which FSIs have gained income, i.e. Real focus on increasing direct deposits and transactions. Whilst many banks are starting to focus in on cross-selling and deepening relationships. Of course, that's great, and our research shows that incumbents are typically making about £500 to £600 of revenue per customer, whilst challengers are tending to make about half that, and many fintechs and digital banks are sort of struggling to break even, as we saw so powerfully from Neil's presentation just now. Of course, this is a model then for fintechs that relies on funding. In a world where COVID has significantly impacted transactional income, and also with a long-term suppressed interest rate, this starts to provide a challenge around funding for many startups. And in fact, recent data shows that whilst in half one 2019, there were more than 500 deals done to fund fintechs. Actually, that had dropped by half one 20 to about 300 deals. So it starts to provide a real reason and a focus for fintechs to make money quickly and focus on the profitability. So how do you make money from customers when you're scaling? The answer is really in pivoting up this curve, very much focusing around some of the points we just heard around partnership and service revenue. You need to look at non-interest income and other fees and commissions. And in fact, to just put a little bit more colour, Starling's latest results from October 2020, which are publicly available, show a nearly 50-50 split between interest income and non-interest income. And I think this just demonstrates kind of where the focus on profitability starts to come in. So how do you really sort of bring this profitability life? How do you create the offering that helps you to attract and grow these types of customers? Well, our research really showed that it came down to 5 key elements. If I briefly talk through those, I'm then going to focus in on 3 that I think are most pertinent to this conversation. First of all, customer-focused metrics. In our view, metrics fall into 3 key groups: what types of data and how complete your data is, what value you have in your customer base and the type of customers you want to acquire, and how engaged your customers are. And we'll see in a moment how looking at value and engagement together can really help you determine who you want to acquire and who you want to grow. If we work on through this house then, it is absolutely key that you take advantage of some of the infrastructure and the opportunities delivered by the more agile technology that is now available to be able to reimagine how you use and how you bring customer data together. For the first time, FSIs can actually move from product-centric systems to customer-centric systems and have a real view of customers and how they're behaving. There's also the opportunity now to really deliver personalized and real-time experience management, allowing customers, even if they're just interacting with you across a mobile channel, to really have very fluid, personalized journeys, offering contextual triggers at the right time so that you can really respond to their behavior. All of this customer data helps you to drive targeted proposition development. And one of the opportunities to make money in this new world is to be much more focused around which customers you want and what propositions and needs you're really addressing. Finally, all of this bubbles up to what we're calling the trust equation. And the trust equation is something that many of the incumbents have become familiar with over the last few years as they've tried to really sort of rebuild that trust relationship. Presents a really interesting challenge for new banks and new entrants into it who actually have a level of trust for granted, but now need to be able to deliver on it as they scale. So let's look at this in a little bit more detail. Let's talk a little bit about reimagining data to acquire and grow. All of this new customer understanding gives you the opportunity to start to bring together what you know and who you want to have. Here we plotted a sort of hypothetical matrix of the very digitally active customers and the very high current value customers. If you can look at who you've got, who is most engaged and delivering most value to you at the moment, it helps you to understand how do you retain those best and how do you turn more of your customers into those, and ultimately how do you acquire more of those customers. Interestingly, if we compare some of the acquisition strategies that are currently in the market, up until last year, many of the most successful incumbent acquirers were effectively acquiring at a discount, often offering cash back for refer a friend. For example, Nationwide has run a scheme like this for many years. If you start to look at different strategies whereby you're actually using a proposition to acquire rather than a discount, you're immediately starting to target the right types of customers. Equally, the new types of technology that we've been talking about in terms of MarTech allow you for the first time to also be able to go off platform and really understand what your customers are doing, and therefore go and find customers that look like that in order to be able to acquire and grow the right customers. So lots and lots of opportunities around using customer-centric data that you can now collect and gather at very, very low cost. This all brings you to targeting your proposition. And here the strapline is niche is mainstream. For so many years, actually, universal banks really were able to survive on a universal offer, a very untailored offer that was really targeted at the mass market. With lower costs and the opportunity to understand more about your customers, it's very easy to tailor services to underserved segments. And the flexibility of data storage and the ability to spin up a proposition allows you to be much faster to market. Daylight is a recent great example of this, a bank that launched in November in the US, targeted specifically at the needs of the LGBT+ community, historically an underserved segment. And I think this is an example of where lots of new entrants are going to target, picking off particular segments who've been underserved by the existing mainstream banks. In the meantime, universal banks will try and get around some of their less flexible infrastructures by partnering up. And we heard earlier how important that is. They'll continue to diversify their portfolio whilst trying to remove cost. And they'll try and retain and grow their current customer set through collaboration with fintechs. And Wealthify is a really good example of this with their recent partnership with TSB, trying to really sort of bring that ecosystem into mainstream banking. Interestingly, it's also TSB's first foray into commission-based banking. It's been announced that the commission is going to be split 50-50 between the partners. Of course, there's also a further model which is going to be very important in terms of generating income in the future, and that's the growth of embedded finance. And I think we're going to see both universal banks and also niche banks sort of participating in this. Of course, Amazon has really led the way, creating banking services to improve opportunities for customers in its ecosystem, as well as improve opportunities for merchants. And I think we will see a lot more retailers heading in this direction. But it's a great opportunity to really generate a proposition that actually supports your core business, where financial services can add to the customer offering. The purpose of all this targeting, though, it is around creating repeat revenue. And I wanted just to touch on a little bit what really makes a good proposition to drive repeat revenue. Some of the research we've done has shown that there are really sort of 4 key elements to this. We've already talked a little bit about the personalized experience and the ease of doing this with today's digital technology. But there's a couple of other things that from a FS perspective are perhaps a little bit underserved now, but where we see great opportunity in the future. So if you look at one of these, content is going to become increasingly important. Whilst most FSIs look at how often users come to their sites, what transactions they take, actually the next thing to look at is going to be quality of interaction. Who's coming to your site for non-transactional activity? Who's using their app, for example, for savings pots? You want to be creating engagement and really using content to bring people so that you can learn more about them. You can then target propositions more effectively. Community is also going to be increasingly important, and we're seeing more of this around the SMB side with kind of self-help ecosystems. Monzo has tried this, is probably the pioneer within the UK with the Monzo Noughts. They haven't really been able to monetize the community feeling yet, but certainly on the SMB side, we're seeing more and more activity in this domain. So finally, if you've got your proposition right, you know who you're acquiring and why you're acquiring them. Isn't the trust equation easy? Aren't you delivering on what you really need to deliver? Well, actually, yes, for single services and single towers, it is relatively easy at the moment for new banks. The challenge starts to arrive when you're scaling. Here, one of the things that was so important in our research was actually looking at the trust equation and how that was delivered, and really the requirement for a new operating model to be able to deliver across the customer promise, across all services. One watch out here for new and growing businesses is going to be data protection. There was an example last year of Dave, which is a US bank, getting caught out by finding nearly 10 million of its customer records for sale online. Obviously, the US has slightly different data protection requirements to Europe, but security, amongst others, is going to be an area that fintechs are going to need to look at really carefully as they scale, and really make sure that they can deliver on the customer promise. So in conclusion, how do you make money these days if you're entering into banking? Well, it's not all about traditional business models. It's pivoting increasingly to more traditional services and fees. Make sure that you understand who you want as a customer and try and acquire them profitably. I would add as well, I think we heard from Neil, serve them profitably as well. And make sure that your proposition is targeted specifically on those customer needs and pain points, and that you're bringing in increasingly recurring revenue, not just a one-off purchase. You also want to use all of the opportunities delivered by digital data to actually have interactions at almost no cost. So you want to drive engagement with content and community to increase return visits. If you can do all of this and start scaling your services, then the key thing is going to be making sure that your operating model supports the trust and the delivery of the customer promise that you've set out. Helen, I'll hand back over to you.
Thank you very much, Joe. I was actually sitting here between both of these presentations, I'm sitting here marveling at how quickly we've gone from the initial, let's call them challenger digital propositions that were rolled out not too many years ago, as Neil informed us, to this concept of community, communities of affinity, communities being served with personalized propositions, content-driven and non-interest income driven, went very quickly, didn't it, over these few years? So one thing I think that is to point out, yes, the lower cost structure and storage is cheaper and the technology is there, but the speed at which it's changing is remarkable. Thank you very much, Joe. Now, for our next presentation, we're going to move on to look at more of the technology. So Nigel Cyrick from Vacuumlabs, Head of Digital Banking, you're going to give us the lens of what technology considerations we need to have for a winning formula. So Nigel, I'm going to hand over to you.
Thank you, Elaine. Let me just share my desktop, and I will turn my video on as well, hopefully. No, you don't look as if you've got video. Hello, everybody. Good afternoon here in Europe, and good morning or good lunchtime in the US. Helene has outlined some considerations, and Joe, thank you very much for, I suppose, introducing the concept of customer centricity. Now you have your vision for new banking services, for new profitable banking services. How are you going to bring them to life? And this is where technology is the enabler. If you get it right, and you will give your customers wonderful experiences, you will also significantly lower the cost to serve. If you get it wrong, your proposition probably fails. So what I'm going to look at today, I'm going to touch upon three key technology considerations. Firstly, why do I need a new technology stack? Secondly, the value in leveraging the fintech ecosystem. And finally, I'm going to touch upon building customer experience. So if I start, why do I actually need a new technology stack? Why can't I use what I've already got in place? Well, if you're an incumbent bank systems, let's have a quick history lesson. Bank systems have developed over many years. They're monolithic by nature. They're incredibly complex, but most importantly, they are product centric. If you walk into a legacy bank in many geographies around the world, the current account system, the credit card system, mortgages, lending, savings, these are all quite frequently different systems or different areas of one large monolithic solution. The challenge is that they're not architected to incorporate any external non-financial services, which, as Joe outlined, are going to become increasingly important in the future. They're incredibly slow to change. They're very costly to maintain. You're having to take the whole system down if you want to make a single change. It's incredibly hard for an incumbent bank to maintain its day-to-day business as usual operations and to change in parallel. A lot of incumbent banks have looked and said, our customers are connected, the world is connected. The solution is very easy. We need to move to the cloud. But if you just take what you have today, your existing solutions, your existing processes, the existing products, the existing services, if you just move them to the cloud, all you're really doing is running the same technology and providing the same services, the same products on somebody else's different hardware, or in a different building, or a different data center. So in the new world, if you really want to drive profitable customer-centric services, you need solutions that are architected for the cloud from day one. Solutions that are going to have microservices, they're going to have containers where the system can be broken down into many components, and those components can be changed frequently, and they can be changed in parallel to providing that 24/7 banking service. Moving on, if we look at the fintech ecosystem, I think banks with their monolithic solutions in the 90s and the early noughties, there was a transition to a best of breed approach. For anybody technical on the call, the concept of service buses and orchestration layers came to the fore. But all this really meant is you bought another monolithic vendor solution, and you ended up with packages that were running on different technologies. They had to be integrated, usually string and candle wax. So today, if you look at the fintech world, we've moved on. The fintech world is inherently cloud native. Fintech services are made accessible via open APIs. You can simply integrate these and consume the API into the digital banking proposition you want to build. So this means you do not have to reinvent the wheel. If you need to run a KYC check, if you need to issue a credit card, if you want to collect data about an SME's invoicing, if you want to allow your customers to book a session in the gym or to trade stocks, none of those services are traditional financial products. So today, from an architecture perspective, a bank, if it's an incumbent bank looking to get into the fintech space, they're standing up new technology stacks. These stacks, as I mentioned earlier, are going to have a microservices architecture that enables components of the proposition to be easily incorporated. The great news is you're then not locked into vendors on their sort of 10-year cycle. You know, if you want to rip out the KYC service because there's something better or more applicable to your solution now available in the market, or there's a new piece of fintech innovation somewhere else, there's a new payment gateway service, you can flip these things in and out incredibly quickly today. So most importantly, however, if you leverage the fintech ecosystem, you don't have to rebuild things that have already been built by others. You can channel your energy into focusing on the areas of your proposition that speak specifically to your client base, your customer base, your target demographic, and where you're trying to be different to competitors in the market. In the API-driven world, it's never been easier for a bank to spin up a new tech stack to support new services and new customer segments. And the key word here is services. In our API-driven world, we're not product-centric, we're customer-centric, we are services-centric. If you're a non-bank, so anybody dialing into this call, you're in a different industry vertical, for example, but you're looking to launch financial propositions. Again, the great news is you're not starting from scratch. All the heavy lifting has already been done for you. All the connectivity to the global financial infrastructure is available via banking as a service providers. These platforms can provide your core banking, your card issuing, your payments, your lending, foreign exchange. They've done it for you, which means you as the non-FSI just have to focus on your client engagement and the front end and your customers and your proposition. I wanted to walk through at this point an example. We were working recently with a large European grocery wholesaler, and they had a very large captive audience of small businesses, and as a consequence of wanting to remain relevant to their client base, increasing their profitability, and also supporting some of their customers through hard COVID times, they decided to develop a financial proposition which would allow them to use their balance sheet, use their excess liquidity, but it would also allow them to focus on what were the needs of those small businesses. Did those businesses need installment plans? Did they need to be able to defer payment of invoices? More importantly, this particular client could start with a banking as a service platform. They didn't have to worry. Connectivity was there. They didn't have to become a bank. All they had to do was develop the customer proposition. And in this example, as a non-FSI, the real benefit was that they were able to bridge from the financial transaction of the client to the behavior of that client or customer with their normal day-to-day business. What were they buying? When did they buy it? How frequently? How much did they spend? So the ability to analyze and use predictive analytics and data analytics flowed through into ultimately an invoice finance proposition for their clients on the other side. So a good example of a non-FSI moving into delivering financial services without being a bank and leveraging that fintech ecosystem as their starting point. But finally, a few comments to wrap up on building customer experience. I think it's very important to remember, if all you do is digitize how the bank works today, what you're doing is simply providing a web or a mobile app as a channel into your existing infrastructure, your existing product-centric systems. These do not drive new services. All they do is give the customer a shiny new toy to do the same things they were doing previously. I call it lipstick on a pig. If you look at it from a non-financial perspective, Joe was alluding to fee income. If you look at rewards, you look at loyalty, you look at travel, you look at shopping. None of those are traditional financial products. Having a cloud-native, microservices-based, fintech ecosystem-driven solution means you can pull those things in that are relevant to your customers and combine them with more traditional financial products. And that way you come up with new services propositions. You really significantly drive down the cost to serve. You become more relevant. And the technology to do this today is there. Parts of it are out of the box. Parts of it are in the ecosystem, and it's very, very easy today to get started. And people like ourselves package and assemble that for you into solutions. So three key takeaways for you. Don't build, please, on an old chassis. Start with a cloud-native approach. Architect your solutions for the future. Microservices, APIs, components. Focus on your differentiators. There's no value to be gained from commoditized services, so plug them in from elsewhere. Focus on those differentiators. It's never been easier to start on the right path. We're here to help you. Look forward to talking to each and every one of you later on. Thank you.
Thank you, Nigel. Thank you very much. I think listening to all three presenters, what's clear is that need to put the customer in the driving seat, and we need to have these customer-centric propositions, but we need to use the technology to enable that to happen in an economically profitable way, to look at different ways of making our income. We look back at the people that started in the market when it was a relatively fresh new thing. When we look at the Revoluts, I was fortunate enough to meet them in 2015, the Starling Banks and the Monzos. Monzo, who had some of its sourcing out and then moved it in, and the impact that that had on it. And I think overwhelmingly what I'm struck by is the lack of a clear and formed community before they started on their journey. They were all in the cloud, of course, but that time to build the community, the money to build the community. And Neil, you touched on all the fundraising that happened there. Then something happens like a shock situation like we're in now, and everyone is called to task. Is it profitable? Will it be able to continue as a going concern? So there's so much to consider about the proposition, the personalization, the content, and the way that you transition your business model as well as your technology. So I appreciate everyone staying with us because we are running over time, but I'm enjoying it, and I'm sure you are as well. And we're about to move on to our panel, which is to be or not to be a bank again. And actually, Nigel, you left us with the cloud and cloud native, and we're going to be joined by Travis Clark-Walker, who is the CMO of Thought Machine and very much in the cloud native space, and also Faith Reynolds, who's a strategic advisor. And for the purposes of this evening, she's also the conscience of the panel because she's going to be reminding us of the customer in all this equation. We talked about funding and propositions and technology, but of course, ultimately, we're all here to add value to the customer. So I want to also just roll back a little bit. I mentioned the cloud, and I want to get deeper into the cloud because I'm not entirely convinced that everyone knows what we're talking about when we're talking about being cloud native. If you think back, and all of you will have experienced this a few years ago, I can remember incumbent banks running 10 miles in the other direction if we even mentioned the cloud. And whose cloud was that? My cloud, iCloud, your cloud, forget about AWS cloud. While all these new challenges were going straight into AWS. And I say that because, again, in our audience tonight, we might have some non-FIs, we might have some incumbents, and we might have some people that are starting from scratch. So I do want to look at the cloud and what that is as well. So if I were to roll it entirely back, if you're in this position and you've decided that you need, as I said at the beginning, you may have had this placed on your table, or it's going to be placed on your table or your desk to say you are responsible for our digital strategy, our digital banking strategy, our digital financial and services. Where does one start? Travis, would you like to start us?
Thank you. Great to be with everybody this evening, this morning, if over on the US side. So look, where do you start? I think in many respects, kind of Nigel summed it up with, you start with a new. So you start with completely modernly architected applications. I'll come to your point on cloud as we go through the session, but you also almost certainly start on cloud infrastructure. And then the final point is start. There's lots of procrastination on, shall we do it? Shan't we do it? Is the technology there, etc. But all of the technology is available. The fintech ecosystem at large, and we consider it, as a community, a team sport, is available. Continuous integrations, continuous delivery, microservice architectures lend themselves to starting a program. Find the appropriate vendors, put the applications together, create your propositions, and make a start. And that applies equally to incumbent banks as it does to new generation banks and those that want to get into the kind of financial industry space. And even if they don't want to be a bank themselves, technology exists to provide for that. But the overarching statement is start with new technology.
Unmute myself, that famous phrase of 2020. Neil, would you like to give your views on this?
You're going
Hello.
back to 2020 as
You-
well.
You're here. You're here.
You're having a lot of tech where you are, right?
It's all about the tech. Yeah, we're actually an organisation that's gone through our own journey into the cloud as well. We have a sizable customer base, not only in UK and Europe, but globally, in North America, Southeast Asia, and now in the Middle East as well. So, from a, again, back to the previous point about, start with your proposition, and do you want to be a domestic or an international or a global player? If you go out with the mindset of domestic, actually the organizations that you might partner with are very, very different to those that you might want to partner with if you want to go truly global. And let's be honest, there's no such thing as a truly global bank. Even HSBC, with all their assets, to Nigel's point earlier, I've worked at HSBC for a number of years, and each banking region is very, very different. We're using different technologies, different stacks. So I think the key thing is really understand the tech requirements and what you need, but it's not all about the tech. There's when you're launching a bank in Malaysia, is very different, literally 50 minutes down the road in Singapore is very different to a hop over to Australia or New Zealand. Is very different to UK, Europe, etc. So you need to understand the regulatory requirements as well, and have those trusted and proven partnerships that can actually help deliver it. Don't try and do it all yourself. It's folly. You'll burn a lot of cash, and you will fail, unfortunately. There's as Nigel said, there are players in the marketplace that are there and are built specifically to assist those launches, and are experienced in those launches. So leverage the skill that's out there, and at the right time, it might be that you insource certain aspects of it. That's just life, right? You want to build your own asset and your own IP. Get it. Just don't try and boil the ocean all at the same time yourselves.
And I think when you get into scale, I know, Joe, as you said, once you start to try and scale, the building inside is a little bit more difficult if you're actually going to get to scale at speed. And at some point, all the money that's been poured into these new propositions will have to generate a return. So there's the customer economics, but there's also the investor and the shareholder economics, and you're balancing them together. I mean, we're talking about whether or not the bank is the proposition to build a bank or to build some banking propositions, products and services. How do you make that decision? Joe, you might want to lead on this a bit as well. And Nigel, of course, when we're looking at the technology, how do I decide? Is it a bank or is it not a bank? What's the, what are some of the guidelines for saying, should I go get a license, or should I just look at do I have a community that just needs some products and services?
Would you like me to start?
Go ahead.
Well, I think I would say there's a difference, isn't there, if you're a going concern already versus sort of targeting new entry. I think if you're a going concern already, you're going to be thinking about whether you want to carry some of the the capital risk that Neil was highlighting as you're thinking about getting a banking license. And actually, I would always bring it back to the customer. Do your customers want you to be a bank? Can you offer them greater propositions through that, or actually can you maybe pick off some of the relevant services and add that to your propositions? I guess that's one lens. And then if you're a new entrant, then I think it depends. You need to think a little bit about how far you want to scale, what level of services, and whether actually your niche is a particular part of the ecosystem, which doesn't always require a banking license, but can be very profitable, or whether you actually want to be more of a consumer-facing full service, but perhaps targeting a particular niche, as we saw with Daylight, for example.
Exactly. Actually, I would like to talk a little bit about the customers. Faith, welcome. And maybe you can share a little bit about your background. I said that you were going to keep us on track and be our conscience. And so you will potentially be, so looking at the customer, as we've been speaking about the customer in this proposition. And of course, regulation like open banking, which opens up the possibility for great things, but also can come with its own problems if not treated properly.
Yeah, that's right. So thank you, Helen. It's lovely, Helen. It's lovely to be here today, and hello to everybody who's made it online. So my background, I'm a strategic advisor to industry regulators and also in the not-for-profit sector. I work primarily around advocating for consumer interests, and I have a very close relationship with regulatory initiatives in the UK, like open banking and smart data, and also current account switch service. So I have a range of different hats, all really around tech, around consumers, making sure that things deliver. And I think, one of the key things that sort of come across in some of the conversations for me today is about really being clear at the start what your purpose is and what it is you're trying to deliver and for whom. And this is really important in terms of thinking about the outcomes of what you're delivering and where you're trying to get to. Quite often I speak to very enthusiastic startups and entrepreneurs who are very passionate about where they're trying to get to, but on the way their product does get compromised by the requirements of venture capitalists and investors, and it's hard to deliver against that outcome. So thinking really carefully about the business model and how you can balance the need and desire to deliver something for consumers with the needs of your investors and a sustainable business model is really important. And I think the other thing which I'm kind of struck by is the environment within which we are in, the context. Actually having a deep understanding of the context. It's very easy to get focused on the business side and on technology and on financial services, where we're all in good, well-paid jobs. But actually, I mean, at least in the UK, we've got over 50% of our population can't make it to payday without going into their overdraft. We've got, last November reported that £6 billion additional debt as a result, directly resulted as the pandemic. And of course, that's continued. And they're saying that there's going to be a delay. We're not going to see this immediately. It's going to be coming downstream. And so for a lot of people, really, problems with debt, their savings would have been interrupted, their pensions would have been undermined. And then for another smaller group of people, they've got loads of money because they just carried on working, but with none of the external costs. So thinking about actually how are people living their lives, what's going on, how can we actually serve those people? And particularly when thinking about the outcome is actually, how does our product make somebody better off? How are we increasing their financial well-being? And I think this goes a little bit to the points Joanne was making around customer experience. We are somewhat, as consumers, a bit tired with, being ripped off, having to, find out only after the event that something's gone wrong. So I think there's very much importance between the experience, but that experience delivering better financial well-being. And to give an example, and then I'll finish, Helen, and you can pass on. But, Klarna, buy now, pay later schemes, done a great job of meeting those kinds of requirements for knowing their customers and being kind of slick and attractive and getting the experience right. But they weren't thinking about the outcome downstream and how their job was there to improve financial well-being. And so a whole host of people during the pandemic have been buying stuff on credit that they can't afford to pay back because they love the feeling of getting something through the post. So these embedded finance models do then attract regulatory attention. So that's what we've seen. Now they're looking at bringing it into the regulatory perimeter. So I think there's definitely something about how is our product actually delivering a really good outcome, not just a great experience.
I agree with you. And of course, today there was a report published by the FCA on vulnerability and resiliency as well. So it is on everybody's watch list. Nigel, you mentioned the micro versus monolithic build, and Travis, we talk about being in the cloud, which we'll dig into. Faith, you're talking about the fact that we need to be more responsive to the needs of our customers and do it profitably. Joe, Neil, I'll come to you in a minute. Is it that we are able to be more agile and more flexible by having either an outsourcing model or building straight onto the cloud and being in this micro environment using APIs? And so we provide a better return to that customer, who then in turn stays with us and becomes more profitable. Nigel?
I was going to let Travis lead on that. Otherwise, I'll spill his thunder.
Travis, you go ahead.
I'll happily lead on. Thanks for the prompt. So look, I think there's a few important considerations in here. Cloud infrastructure in its own right doesn't change the proposition that you build. The applications that you run on it do, and we heard earlier from Nigel in terms of completely modernly architected microservices, flexible applications are what creates the opportunity for better products, because you can develop faster, to your point on agility. And I think this does play to kind of the consumer impact piece, which is if you can continually develop a product, buy now, pay later will be a good example, and you can then build additional flexibilities in it. You can understand the customer's behavior as a result of it, and you can adapt that product in real time in front of the customer, then there is an enormous benefit. So it is about the technology that you choose to run on cloud infrastructure as much as cloud infrastructure itself. But there is also the benefit of the horizontal scalability and therefore the cost efficiencies of cloud infrastructure. And you combine those things together and you result in a faster pace of change, a change that is unique and relevant to your customer base, the proposition you've chosen to build, and a cost reduction relative to traditional architectures. All of those things brought together mean that, yes, you are a more efficient financial institution at serving customer, at having a lower cost income ratio, and resulting in better customer experiences. So it is a combination of all of the parts. It isn't just that the cloud somehow magically changes your propositions. It doesn't. What does change your proposition is a combination of all of those things together.
Very well.
And I think, Elaine, I would add, and picking up on Faith's points, one of the advantages to society by driving down those operating costs, when we look at the financially excluded, the unbanked or the underbanked, the usual dilemma is, how do I make money out of that market segment? How do I cover my costs? If I'm operating in a much lower cost model, my ability to absorb those society services is so much higher than it would be otherwise.
Yes, just to build on that point. I mean, during the pandemic, we've had all sorts of challenges, but one of the ones that the financial institutions had at large was the requirement to create interest holidays or to reduce interest burden, stretch it out. Significant volumes of that required manual intervention into the systems in the background, and that is a cost to do. Now, if that had been automated, if the technology had been in play where, a few flicks of a switch, if you like, at a development level, meant that you were able to place those opportunities in front of customers, the cost of providing the change massively outweighs the benefits, massively outweighs the cost of doing so, and therefore you can actually proactively put these types of propositions in the market rather than waiting to be forced to do so. Just building on Nigel's point there, on the lower cost to serve results in innovation for those that wouldn't otherwise have got to it.
I'm reminded of the joke that's been going around and around and around about what accelerated your digital transformation. We all know the answer is COVID, right? If as I said, it pushed. I said this earlier. If you weren't there, you definitely are there now, and if you were there, it's accelerated. And as Nigel said before, some of it is lipstick on a pig, and some of it is going further back in the chain. And I think we saw even, and this is globally, money getting out into the bank accounts of individuals or small businesses was definitely more problematic for incumbents than it was for alternative finance providers and digital operators, whether that was UX or that was any other part of the chain. And the press in this country came out screaming in a written sense, saying this is not good enough because people need the money now. And then back to the point of being able to be flexible and agile enough to serve the people that needed it at the time. And any of us who lived through 2007, 2008 know that it's going to happen in 2 years, 1 year and 2 years from now, as Faith mentioned, where we're going to see more of the fallout. It's not all doom and gloom, and this is probably a great time to look at if you're going into this space, going agile, going in the cloud. I want to, we talk about the cloud and cloud native, and I jested before about all the different clouds and how incumbents ran away. I'm sure that our audience is very savvy, but for those who might be there that are not clear about all the cloud definitions, maybe we can just have some 101 on the cloud.
101 cloud. Okay. I think the first thing to say is it's not new, right? So, there are plenty of industries that have used cloud infrastructure very successfully for, many, many a year. And I guess if you take something like media and media streaming, that's a very good example of one that relies, very, very heavily on cloud infrastructure. But, the very simple version of it, of course, is it's, AWS or GCP or Microsoft Azure. These are, data center constructs provided by third-party providers. The result of which is that they have the economic scale of providing the service. They have the responsibility of managing the hardware, and you buy it as effectively a subscription usage model. But it comes with a whole host of additional tooling, which means that you can run the services on it. Taking that out of your organizational responsibility and placing it with somebody else has enormous cost benefits. But it is important that the technology you run on it is designed to run on it. But fundamentally, it is having the hardware managed and administered by somebody else with supporting tooling for how you construct your application stack. And the most important bit, I think, is that it has come of age from a security, third-party management, financial services regulators around the world now being accepting of it. So your point is, a few years back, people go, oh no, never. I think we are seeing a very significant march from regulators all around the world, recognizing the cost efficiencies to the earlier point, and those being passed on to customers, recognizing the security and scalability benefits, meaning that services don't go out, and with the right applications run on them, the opportunity for continuous innovation, continuous integrations, and continuous delivery, which means that services are not going out. Combine all of those things, and the summary is cloud is of age for financial services.
And it was the security question that I was going to ask you, because I think a few years ago, that's what it was. Or if you went to the regulators to get a license and they asked you where your data was stored and you said in the cloud, and they said, where's the cloud? Right. And it's not 5 rooms of AS400. So that we've obviously passed that. I think it's probably been exacerbated, but as you said, and in parts of the world where we don't have heavy legacy systems, perhaps like the Middle East, where we don't have the rooms and rooms full of AS400s and very siloed, easier for them to get started in the new proposition. And then are we just looking at what is the proposition, who is the community, and how can we outsource, partner with other products and services to make it a success? Joe?
Well, certainly easier to get started if you don't have legacy infrastructure. I think that there's also a regulatory point as well, isn't there? Some of these, you see, I'm not an expert on the Middle East, but if I looked at APAC, for example, there is a flourishing fintech ecosystem there, which is partly driven by technology, but also by the low reg environment.
And Faith, would you like to add anything on the regulatory side?
Yeah, so I think one of the things that I'm also struck by, which is when you have the cloud and when you have these different, so I think different data sets that you can begin to pull together to start looking at your customers and designing services that are closest to their needs and thinking about how do we get more and more data about them, you are going to see this sort of the challenges around blurring of regulatory lines. And so I think this is something that I'm particularly conscious of is that there is a bit of a challenge for regulators actually to keep up with this. But what does it mean, when you, from a consumer point of view, when you're having your data taken from different places and then you're having it provided in a really nice, sophisticated product, but the terms and conditions around that are just, you can't get through them. They're pages upon pages because you're dealing with so many different providers in the chain and so many different kinds of different protections in different spaces. So from a kind of regulatory point of view, this sort of use of data, use of cloud, but also the kind of integration of different platforms and of different providers can create sort of quite complex products which attract regulatory interest and also are challenging to communicate to the consumer. And so there is something in all of this about keeping it simple. You know, what consumers like are really simple messages, easy to understand stuff, things that are attractive, that do the job that they need them to do, that help them get to where they want to get to without it being really complicated. And if you've got to ask somebody to tick 10 different boxes and accept, you know, 10 different risks and then give them a warning, etc., before you can even get to the product, that's not going to work. So I think there are going to be some challenges downstream about how do we achieve some of this, but also keep it simple from a consumer protection and messaging point of view.
Thank you. Nigel, when you're looking at the tech side of things, it's not happening in a vacuum, even. I didn't know. Yeah, exactly. You know, do you start back with the proposition of let me find out about the customer base so that I'm sure that we're looking at products and services that they want, and then looking at the technology that is going to enable that? But as Faith said, to be simple enough and to take regulatory environments into account. I mean, Vacuumlabs works in the US, in Asia, in the UK, in Europe. We're working everywhere. So the regs must come into that as well somewhere.
They do, and I think you've hit the nail on the head. We have to start at the beginning. I think one of the earlier comments, you know, we're asked, please can you build a copy of Revolut? We have the same conversations at Vacuumlabs week in, week out. I mean, somebody will come and with a mock-up of some designs. This is my proposition, and they've taken screen captures from Monzo, from a US bank, from Mox, from da da da. So we start at the beginning. It's all about what customer segment are you going after? What is your proposition? And we work and follow that through a process that goes from front to back. What services are you going to have to integrate? The regulatory side dictates the type of platforms you will use. And I think the other comment on the regs, regardless of whether you're going to apply for your own licenses, whether you're going to piggyback something we didn't talk about, a lot of the banking as a service platforms can provide you with an e-money license that you can effectively utilize. There's still an elapsed period of time. If you're going to issue a card, you're going to have to be approved by MasterCard or Visa. There is still a regulatory journey. So what we try and do is encourage people start that process, and in parallel, let's work with you on the proposition development, identifying the key technologies you're going to need, and then those two dovetail. By the time you're regulatory approved, whichever form and flavor it is, you've got the first versions of the tech built, and you're in market.
Ready to test. And on a point of the payment process, Neil, there is a podcast available from Vacuumlabs where Joanne Dura, who's the CEO of GPS, talked me through a payment journey. Amazing how much is happening in a few seconds. So and I know we're keeping people from the round tables where we're all going to, but I thought it was important because I think people, as Travis, as you said, there was a security issue in people's minds that was probably not real, but it was there years ago in terms of the cloud, and we've got over that now. Neil's taken us on a journey from some of the early entrants into this market. It's gone well for some, it hasn't gone well for others. There have been some non-interest sources of revenue, as Joe mentioned at Starling Bank. Banking as a software service and faster payments were the way they made their revenue initially. It wasn't by bringing on more customers. I was struck by the lack of genuine community that they were accumulating with all those, with all the money, that nearly £1 billion of investment across some of them. They were building a community versus having a community, which you already had with Daylight, and how much longer it takes and how much more money it takes, even if you are agile, built in the cloud, digital native, taking everything into consideration, to build that community so that you can then service them better, use the technology to be more agile, more nimble, and respond. But everything is not around the product and the pricing, it's around the experience and the content. And most importantly, working with partners who can help you to enable that for your end user, because after all, that's what we're all here for. So I thank everyone, and I thank the audience, and I think if we're moving to, thank you, everyone saying thank you very much in the chat as well. We're moving to the rooms now. This space will stay live for a while. And I think Kika and the marketing team will then activate all the roundtables for us to go to. Thank you to everyone.
Thank you.